Individual incentives. A sales bonus is a typical incentive. Employees receive bonuses, special payments, above their salaries when they sell a certain number or certain dollar amount of goods for the year. Employees who fail to reach this goal earn no bonuses at all. Merit salary systems link pay rises to performance level in non sales jobs. For example, many baseball players have contracts clauses that pay them bonuses for hitting over 300, making the All Star team, or being named Most Valuable Player. Executives commonly receive stock options as incentives. Disney CEO Michael Eisner, for example, can buy several thousand shares of the company's stock each year at a predetermined price. If his managerial talent leads to higher profits and stock prices, he can buy the stock at a price lower than the market value for which, in theory, he is largely responsible. He is then free to sell the stock at the market price, keeping the profits for himself. Executive stock options have unfortunately been at the center of some of the recent accounting scandals plaguing some businesses today. In a nutshell, firms have chosen not to treat them as expenses at the time they were granted, contrary to what accountants suggest. In response to growing criticism, some companies, such as Coca Cola, have announced plans to change how they account for the stock options. A newer incentive plan is called Pay for Performance Variable Pay. In a sense, middle managers are rewarded for especially productive output for producing earnings that significantly exceed the cost of bonuses. Such incentives have long been common among the top level executives and factory workers, but variable pay goes to middle managers on the basis of company wide performance, business unit performance, personal record, and all three factors considered together. The number of variable pay programs in the United States has been growing consistently for the last decade, and most experts predict that they will continue to grow in popularity. Eligible managers must often forego merit and entitlement raises, increases for staying on and reporting to the work every day. But many firms say that variable pay is a better motivator because the range between the generous and mediocre merit raises is usually quite small anyway. Merit raises also increase fixed cost. They are added to basic pay. An increase in the base pay is used to determine the retirement benefits that the company must pay for. And the employees do get the best of the benefits in their retirement benefits. Well, having had talked about the individual incentives, now let's talk about the collective incentives, something that we call company wide incentives. Some incentive programs apply to all the employees in a firm. Under profit sharing plans, for example, profit earned by a certain level are distributed to employees. Conversely, gain sharing plans distribute bonuses to the employees when the company's costs are reduced through greater work efficiency. Pay for knowledge plans encourage workers to learn new skills and become proficient at different jobs. They receive additional pay for each new skill or job that they master. Benefit programs. We'll talk more about the benefit programs as we move ahead in our discussion, in our tutorials. A growing part of nearly every firm's compensation system is its benefit programs. Benefits compensation other than wages, salaries offered by a firm to its worker, comprise a large percentage of most compensation in budgets.